Hello, everyone. In this session, we're going to talk about our management accounting decision and control. And this is our practice assessment too. And we're going to look at question number 5. So we have done the previous recording and we have done from question number 1 to 4. So we're going to look at now question number 5. So question number 5, as usual, it will be our written question. And this question definitely will be from the writing part, so we need to make sure like we are ready for the writing question. So let's read this question. So identify two characteristics for each of the following standard. So you have an ideal standard and we have a basic standard. Now let's try to understand what is it. Ideal standard is also called perfect standard. Perfect standard. What does that mean, perfect standard? Perfect standard is the standard where everything is done perfectly. That means there will be no wastage of the material, there will be no idle time for the labor, and the way budget will be set up, there will be no inefficiency. So this one is a very difficult to achieve in real life. In real life, it is not possible to achieve ideal standard as it consider no wastage and no idle time. So I think it's more than enough for the 2 marks. Writing 2 sentences is more than enough to have 2 marks in the exam. On the other hand, the basic standard is the historic standard, or the standard that is keep following for a long time. So it's a historic standard and did not changed for a long time. The problem with the basic standard is it's been a long time, the price for the material or rate for the labor is not changed. For that reason, the material price variance and labor rate variance will be always adverse. Why? Because it's been a long time, we still follow the previous rate and it doesn't consider the inflation, does not consider the inflation. And for that reason, it is shows always the adverse variance for the rate and the price variance for the material. On the other hand, it will be very easy to attainable. So it is easy to achieve as the efficiency and the uses variance are always, so efficiency and the uses variance always favorable, because this standard has been set up long time before and still we follow the same price and same rate, and for that reason obviously it will be always efficiency and the uses variance will be always favorable, and it is very easy to achieve. And for that reason sometimes the employees don't feel too much motivated because there is no challenge on it. It's very to achieve by everyone. But on the other hand, we have to remember that this standard the basic standard, they do not consider any inflation or any current market rate. And for that reason, the price and the rate variance is always adverse. All right, let's have a look. It's only 2 marks question. So if you write 2 sentences, it's more than enough. The next one we have here is M Limited produces handmade boxes of chocolates. The existing standard for 1 box of chocolate is detailed below. So existing standard, that means it's a basic standard. Ingredients, packaging, direct labor. So the total prime cost, all the direct cost, we have 4. M Limited use ideal standard for ingredients. So for the all ingredients, they use ideal standard and basic standard for the direct labor. So for the direct labor, they use basic standard. For the ingredients, they use ideal standard. Now, as we already know, ideal standard is a very difficult to achieve, and the managers never motivate to achieve it because it's not possible to achieve, because the way ideal standard has been set up is like a perfect environment, and that never exists. So that means there will be no wastage, no idle time, no breakdown of the machine, no overtime. So this sort of thing does not exist. So it is a very impossible to achieve, and for that reason, the manager even don't feel motivated to work on it. And on the other hand, the basic standard is always easy to achieve. For that reason, the usage variance and the efficiency variance always favorable, but the basic standard always consider the historic data, and for that reason, the price variance and the rate variance always negative, is adverse because it doesn't consider the inflation. All right, let's have a look what else we have. So you need to write few things. So let's write it down, few information here. So you can see first you can write for the ideal standard, the same discussion. Ideal standard. So you can say perfect environment. Environment where no wastage and idle time. We can say impossible to achieve. And managers will not be motivated to achieve this standard. On the other hand, for the basic standard, we can say easy to achieve. Then we can say the price variance and the rate variance will be adverse because it does not consider inflation and use the historic rate. On the other hand, uses variance and efficiency variance will be favorable. All right, let's move to the next one. The next one we have here, it says M Limited has provided the following additional information. The standard quality of ingredient has been calculated on the basis that no chocolate is spoiled in production. So no chocolate is spoiled on the production. Last year, average level of wastage was 5%. So now you can see this year we make the standard, we say all ingredients, the way we have calculated, there will be no chocolate spoiled. But last year there was a wastage of 5%. So we need to make sure we need to consider this 5%. We need to incorporate this 5%. Otherwise, we'll be shortage of 5% during the production. The standard time to produce a box of chocolate was set many years ago. So that means it's a basic standard. Many years before, we have set up the standard how long it will take to produce one box of chocolate. When the business first started, the production process is now more automated. Productivity has improved by 20%. So that means now most of the job is done by the machine. So before, for example, it was taking half an hour to pack one box. So it should not take now half an hour because now so many things are automated and is improved by 20%. So we cannot use the basic standard. Otherwise, it will be very easy for the labor to achieve this target and the uses or efficiency variance will be always favorable. M Limited now wishes to use normal or attainable standard for all ingredients and for the direct labor. Attainable standard is very easy to achieve, and even though the labor or the ingredients is not even used as supposed to use, then still it will have a favorable variance. So they will not feel any challenge. They will think like this target will be achieved anyway, even if we work slow, even there's a wastage, it still will achieve these targets because it's very easy to achieve. Recommend 3 possible improvement to the existing standard for ingredients. So we need to give 3 recommendation improvement. So we need to say you can do this, you can do this, you can do this to improve the existing standard, that is a basic standard. You should use the information in the scenario to support your recommendation. So let's have a look, 3 recommendations that we're going to provide. The first recommendation we're going to give, that is 5% wastage. So wastage should consider first thing we'll say wastage should consider or incorporated. Wastage should consider or incorporate during the standard setup process. Number 2, 5% input, 5% input will need more because of the wastage. And the last one we can say inflation or the current price for the ingredients should consider. In these 3 should be fine. Next one we have here, recommend 2 possible improvement to the existing standard for labor. You should use the information in the scenario to support your recommendation. So labor will be reduced by 20%, it says, because of the automation. So it will look like, we'll say, the time to make the unit will be less than the attainable standard or normal standard. Because if I can make now production faster by 20%, that means I'll need less time. The next one will be higher rate for labor need to incorporate because of inflation. I think these two are fine. All right, so let's move to our next question. The next question we have here, question number 6. Let's read this question. Let's have a look what we have here. Say task 6 for 15 marks. The table below show management accounts extract for an airline company. So what you have here, accounts extract. So we have a turnover, and then we have a variable cost, then we have a fixed cost. Okay, let's try to have a look at the full thing. So turnover, the first thing we have a turnover, that's the sales. Then we have a variable cost, and then you have a fixed cost, and you have a number of seats. So this is occupied 240,000, and we have a available 300,000. Use the information given to complete the table below, entering the missing figure. Assume that gross profit exclude the fixed cost. Of course, we know that gross profit means sales minus the cost of sales. So there will be no fixed cost there anyway. Show all percentage figure rounded to 2 decimals. So if there is a percentage, for example, anything we need to show percentage, we have to show 2 decimal places. Show all other figure to the nearest whole number. So we need to round up nearest whole number. So if it is, for example, 50.2, we can say 51. Round up. All right, let's have a look. The first question is says asking for selling price per seat. And then we have occupancy rate, variable cost per occupied seat, gross profit margin, fixed cost per occupied seat, contribution per seat, break-even number of seat, break-even turnover, margin of safety, and markup on total cost. All right, let's do one by one for 15 marks question. Let's start with our first one. The first one we have here, selling price per seat. So we have sold 240,000, and the total sales revenue 16,800,000. So let's do that. 16,800,000 divide 240,000, and let's see how much it is. 16,800 divide 240,000, and that gives me 70 per seat. So we're going to say 70 per seat. The next one is the occupancy rate. We have to show as a percentage, 2 decimal. So we have here occupancy. 200 we have occupied, and 300 is the available. So we do 240 divide 300 and times by 100 because percentage, so it's 80%. 80%. So 240 divide 300 times 100 is give you 80%. Variable cost per occupied seat. So how much is the variable cost? 8,400. And the occupied seat is 240,000. So 8,400,000 divide 240,000. That gives me 35. 35 is the variable cost per occupied seat. Gross profit margin, you have to find it out, the gross profit, that is sales minus variable cost. So 16,800 minus the variable cost, and that will give us the gross profit. So 16,800 minus 8,400, that gives me 84. And if we divide with the sales, gross profit divided by sales, that's the formula, and times by 100, and that will tell me how much is the gross profit margin. 168,000 times by 100, and that gives me 50%. So gross profit margin is the 50%. Fixed cost per occupied seat. So let's have a look. How much is the fixed cost? So 6,310 150 divide the occupied seat is 240. 6,310 150 divide 40,000 times by 100. That gives me 6,310 150 divide 240,000 times 100. How much it is? Let's try one second. 6,310 150. That's the fixed cost divided by 240,000. And that gives me 26.29. 26.29. We'll like take 26. Do not round it up. It's the nearest whole number. That means we stay either, if it is more than 5, then we make it the next number, otherwise we just leave as it is. So before I said like you can round it up, don't round it up, the question didn't do it. So it's 26. Fixed cost per occupied seat is 26. All right, the next one we have a contribution per seat. So it's very simple. So we have a selling price is 70 and the variable cost is 35. So selling price minus variable cost, if it will give us the contribution, so that is 35. Break-even number of seat is quite simple as well, BEP. Fixed cost divide contribution per unit. Fixed cost divide contribution per unit. So the fixed cost we have here, 6310150. And the contribution per unit is 35. We have calculated here. So 6310150 divide 35. And that gives me BEP unit, break-even unit, 180,290. So 180,290. Then break-even turnover, break-even sales. So this is the break-even unit, the seat. So if I want to get the turnover, I just multiply with the selling price, that is 70. So it's very simple, times by 70. That gives me 126, 20300. 126, 20300. Margin of safety is the difference between the budgeted sale and the BEP. So we have a budgeted 240,000 seat, and the BEP we have 180,290. So 240,000 minus 180,290. So my margin of safety, they're asking for the percentage here. So I need to divide with that 240. So and times by 100. So it should give you 24.8. So I need to do that budgeted sale, then BEP divide by budgeted sale, again 240, and times by 100. That will give you 24.87. So you can take 24.88%. The last one, I have a markup on total cost. So markup means the profit percentage. So you need to find out how much is the profit. So from the sales, you're going to minus the variable cost and the fixed cost. So we have a sales, this is 16,800. We minus the variable cost, 8,400. We minus the fixed cost, 63,10,150. That's my profit. So 16,800. 16,800, and then 000, and then minus 84,000, and 6310 F0. That gives me 208,9850. And you have to see on the total cost. The total cost is basically variable and the fixed. We added this total cost, how much it is. Need to divide with that. So 84,000 plus 63,10150. That gives me 147,10,150. So I do to multiply by 100 because it's a percentage. So 2089850 divide 14,710,150 times by 100. That gives me 14.2%. So you can take 14% actually. All right, so here, obviously, like with the decimal, you can check it if it is right or wrong. You need to make sure you have a right calculation. So markup means the profit percentage on cost. So if we have a profit, and this profit, how much is the profit on the cost? So you have a two cost here, variable and fixed. We added these two. And we first define the profit. So from the turnover, we minus the variable cost and the fixed cost to find the profit. And that profit, that is our markup. And then we use the cost. Remember that the markup and the margin is two different things. Markup is on the cost and margin is on the sale. So when you have a markup, then cost is 100%. And when there's a margin, the sales is 100% plus the profit. So there is a different way you can do the calculation, but you can find it out which one is the best way for you. So if you do the calculation the right way, you should be fine. All right, so I think like that's it, this question. So if we move to the next question, task 7, we'll do it maybe on the next session, 7 and 8. Thank you very much for watching.